Good afternoon, everyone. Welcome to this session on a turnaround portfolio for the second half of the year. My name is Siva. I represent SIAS, Securities Investors Association of Singapore, which is a registered charity institution of public character. Our goal is to promote good corporate governance and to fight for the rights of small shareholders. All right. Also, investor education. A great deal of the work we do is educating investors on the right way to invest. We have with us today two analysts, one from Maybank, Hussaini Saifi, and Nicholas from Lim and Tan Securities. These guys are frontline. To me, I was a former journalist. I was just a commentator from the sidelines. I'm an armchair critic making comments from the sidelines, observations from the sidelines. But these two gentlemen are in the front line, right? They are the actual experts who put their names to recommendations and they stake their reputations on the stocks that they cover. So I'm very grateful to have them here. I'm also very grateful to the organizers for inviting me to moderate this session. And without further ado, we will start. If you have questions, I believe you can post them through Pigeonhole, and I will try and screen them and ask the questions, pose the questions to the two panelists as and when they come. Otherwise, we will just proceed with the presentation as we planned. Okay, for the second half of this year, possibly the biggest macroeconomic event is interest rates being lowered. As of, let me just share the screen. Sorry. Okay. As of yesterday, or rather Thursday, sorry. Sorry. Okay. The probability of an interest rate cut, guys. This is taken from the CME FedWatch tool, where the futures market is pricing in the probability of a rate cut. So the current interest rates in the US target rate for the federal funds is 5.25 to 5.5%. So you can see this is for the September meeting. This is the meeting on which will be held on the 18th of September. So for this meeting, at the moment, the futures market expects an 88.6% probability that it will be reduced by 25 basis points or a quarter of a percent, 11% probability that it could even be a 50 basis points cut, or even more. So in total, it's actually 100%. So essentially what we are saying here is that the chance of an interest rate cut in September is very, very high. I actually had a look at the next meeting, which is in November, and it's also similar, the interest rate. So I think the market is pricing in at least two cuts before the end of the year. So with that in mind, can I ask our first analyst, Nicholas from Lim and Tan, what sectors that he would look at or he would recommend to benefit from this interest rate cut? So Nicholas?
All right, thanks, Siva. So, but before I begin, I just want to compliment a little bit about what Siva has said. Just want to add on. I know this slide has a lot of things going on, but let's focus on one chart at a time. So the top left chart shows that 31% of CEOs think that rates will be unchanged this year, and 38% think that they will only cut once. And so why is this important? Because despite thinking that the rates are still going to be high, the top right chart shows that CEOs are still confident today as compared to the start of the 2008 crisis or even COVID for that matter, and that this confidence is above 50%, in fact rising. The bottom left chart shows that most CEOs think that even if there's a recession, it will be a brief and shallow one, with limited global spillover. And as we move towards 2024 Q4, they do not anticipate a US recession, which is to me is quite interesting. So, but what's more interesting, to add some color to today's inflation rates, is the bottom right chart. So the headline CPI is now around 3.3%, and the Fed says that the target is 2%. But guess what? 3%, I guess, is probably the new 2%, and it's just a target. So in fact, the historical average CPI is actually higher than 3.8%, as you can see from the top, the bottom right chart, ever since 1974, and we've been so close to 0% interest rates in the past couple of years. So the younger generation might not have felt at high interest rates before, but the older generation will know that previously interest rates were way higher than today's. And because we've enjoyed close to 0% interest rate for so long, we think that today's rates are high, but no, it's normal. Okay, so with that, next slide, please, Siva. So with that, I'll just talk a little bit about the oil and gas sector. So oil has been on a decline since 2014 due to a supply glut, and it stayed at low levels for a long period of time before COVID-19 totally killed the oil due to lesser demand for oil as people stay at home, traveled lesser, etc. But with COVID-19 now behind us, we saw revenge traveling, which led to a surge in oil prices close to the $120 mark. But that also seemed to have settled down. And here we are hovering around the $80 range, which I say is a comfortable level for oil majors to make some money, given the current geopolitical crisis such as the Russian-Ukraine war, Israel-Hamas war. We can be sure that oil will at least stay at these elevated levels. So forget about the noise about who's going to increase supply, cut what levels, etc., OPEC meetings and whatnot. The main thing is that oil prices are now at a comfortable level for oil majors to make money. Okay, next slide, please. So this is a chart which shows the investment history, capex in oil field service and equipment. So basically, remember I said when 2014 was when oil prices plunged, that's when oil majors stopped spending money because it was no longer profitable, or rather as profitable for them to dig out oil in some sense. And this period has been the longest since ever, with the chart stretching all the way from 1921. You can see the many bars of orange below the 0% line at the 2014 mark when oil prices started to crash. And this has a few implications actually. So 10 years have passed. We are now in a recovery cycle where oil majors are starting to spend. The latest major spending occurred beyond 2024. And in terms of vessels, majority of the boats now out there are now at least 10 years old. So most of it is in 2014, as you can see. So this points to high demand of oil by oil majors as a result of higher prices and undersupply of oil field services and equipment due to underinvestment in capex for the past few years. And this could result in an oil and gas super cycle that is expected to last a few years. So you can Google it. There are many articles talking about it. It has been played out since 1-2 years ago, and right now it's being played out in real life. Vessel owners are now making big bucks from renting their vessels. New boats take a long time to build. Reactivating old boats, be it cold or hot stack, need some time and it's expensive. And most importantly, banks are not as willing to finance the oil and gas companies today as compared to the past due to them getting burned previously. So this sort of sets the macro sector for what I want to share with you guys later, more in depth into this oil and gas, especially in Singapore. Yeah.
Okay, thank you for that, Nicholas. So basically, one sector, guys, which Nicholas is talking about is the oil and gas sector. Let me turn my attention now to Husaini. Husaini, can you maybe tell us what sectors you like to play for to benefit from this turnaround in the second half of the year?
Sure. Thanks, Siva, for having me, and good afternoon, everyone. I hope you can hear me well. So,
Yes.
if we take interest rate down cycle as a starting point, then my take on turnaround portfolio is on how to position once US Fed starts cutting rates. Maybe taking a step back, there are two broad camps as far as interest rates is concerned. First are the one who thinks interest rates are likely to stay higher for longer. I am in the other camp wherein I think Fed will start cutting interest rates. Uh, and if we just see after yesterday's inflation print in US, probability of 25 basis point rate cut in each of the upcoming Fed rate cycle starting from September is high, as Siva discussed earlier. So if we take the view that rates down cycle is imminent, I think the upcoming adjustment in portfolio will be in the sectors which are beneficiaries of low interest rates. And in that light, I see two sectors which would be high on investors and fund managers' radar in the coming months and quarters. First is what the common wisdom says, which is REITs, and the second is my favorite, which is telcos. So maybe Siva, if you can go to the next slide, please. So if we delve down a bit deeper into the REIT sector, and as you can see on the screen, the Singapore REITs have underperformed the STI index and the developed property market index in the last 8 to 12 months. So as the interest rates fall, I see or we see there are multiple factors which works in REITs' favor. And few of them includes, first is lower borrowing costs, which means that will help to lift earnings, which means higher dividends, attractive dividend yield relative to bond yields, because as the bond yields goes down, the spread of REITs dividend to bond yields will widen, and higher property value owing to lower discounting rates. And Siva, if you go to next slide, please. So, and even if historically, if we see REITs share price correlation to US bond yields had been relatively high. So from 2009 to 18, it was around 60%. So as the bond yields used to go down or up, the REIT share price used to go up or down. So it was negatively correlated, but the correlation was high. And from 2022 to first half of 2024, or in the last 18 months or so, the correlation was almost 65%. Okay, so REITs, the common wisdom says that REITs usually outperform in the low interest rate cycle. With that, if we go to the second, let's go to the second turnaround portfolio, or where we see the rotation could happen, which is my favorite, telcos. Now, recently we did this report on the telco space, and I'll just go through a few of the highlights. So, in general, like REITs, telcos are also viewed as defensive and yield plays. Siva, if you can go to the next slide, please. So here the same thing. Historically, if we see the top two charts, if you see, the telco share price correlation to US bond yields have been strong at around 60% from 2009 to 18, and around 90% on the right-hand top chart. So the correlation in the last 18 months was almost 90%. The sector has underperformed as the bond yields were high or going up. If you see the bottom two charts as well, this shows that telcos usually outperform broader index in the down interest rate cycle. Okay, and if you see the correlation over here, it is around 60 to 65% negatively correlated to bond yields. So as the bond yields goes down, telcos outperform relative to the broader index. If the bond yields goes up, telcos underperform. So there is high correlation. And with and if the view is that the bond yields are going to go down with Fed rate cut, I think telcos is likely to outperform. Siva, if you can go to the next slide, please. Yeah. So based on the analysis above, we see telcos to relatively outperform in the down interest rate cycle. We put a framework for identifying the telcos, which would be the frontline beneficiaries as rates go down. These factors include correlation to bond yield, gearing levels, capital expenditure, etc., as you can see on the screen. And based on that criteria, Singapore-based Netlink Trust flags very favorably within the ASEAN telco space. So that would be the one name to watch. So with that, let me pause here and pass it on to Siva, and I will reappear for the company section later on.
Okay. Yeah. All right. Before we move into which telcos, so guys, essentially what Hussaini is saying is that he likes the S-REIT sector and telcos. all right, to benefit from an interest rate cut or lower interest rates. All right, I go back to Nicholas now. He's identified the oil and gas sector as the main as what he likes to benefit from lower interest rates. Nicholas, maybe I can turn to you to provide some recommendations, specific types of companies or stocks that you like within this sector.
Sure, Siva. Yeah, next slide. Okay, so before we dive in, just like to highlight the OSV sector, which is a segment of the overall oil and gas, because oil and gas is so big. So another slide which has many things going on, but let's take them apart. But before that, OSVs does the transportation of supplies, equipment, personnel, basically just utility vehicles. And the top left-hand corner shows the latest offshore index in July by Clarksons. So charter rates have been on an uptrend since 2021 and has now surpassed 2008 levels. So one thing to note is that OSV asset owners who are not on long-term charter rates can take advantage of these higher charter rates. So during COVID, when rates are low, boat owners want to lock in longer because they're scared it drops further and they want to be less risky. But now that rates are exponentially higher and it's rising, boats that are on short-term charters can price their rates that better reflect the improving market to make better margins. So remember, a boat is a fixed cost. Not much money is needed after you buy it other than the regular maintenance. So if higher rates pass the threshold, there will be some sort of an operating leverage, J-curve effect, if you will. So once that threshold is passed, every $1 increase in charter rates will directly flow into your bottom line. So some companies like this are players like Marco Polo or Pacific Radiance. Later, I will show you the slides for all the oil and gas players. So the top right-hand corner shows the new build prices going up due to inflation, cost of materials, etc. And even if you want to build, it takes a few years to get the boat out, meaning that supply moving forward will be muted. And the bottom left-hand corner shows that even now with elevated oil prices, the delivery still remains low. There is an increase moving forward, but not enough and very little compared to 2008 to 2014. As I mentioned, most of the boats are built during 2014 levels. And bottom right hand shows the order book, and it's also muted, indicating that the supplies coming to the market moving forward will be very little. So all of these points to OSV owners asset benefiting. And who are the players you see? In US, the biggest, of course, Tidewater. In Singapore, with the likes of Marco Polo, Nam Chong, Pacific Radiance, Atlantic Navigation, Kim Hing, among the players. So there are many of them. Not asking you to invest in all of this, but all of these companies have their kings, and some of you might know the price of these companies have actually soared in the past few months. What I'm really trying to see here is that despite soaring and beside the market being forward-looking, there is still room to grow and much more room, in fact, of course, notwithstanding a deep recession that's looming on everybody's minds. Next slide, please. So this is MOPUs, which are also you can see the different types of vessels, FPSO, semi-sub jackups, etc. So basically, they are also, what I'm trying to say is that like the OSV rates, they are also on the uptrend, and not as many charts as the previous, but the outlook is similar. High demand, low supply. Firms in Singapore that will benefit from this includes players like Dynamac, Beng Quang Marine. If you have followed this, I'm sure you've known that they have risen way, way, way higher in the past few months. All right, next. So some of these, so in this, I think managed to capture most of the Singapore oil and gas players in this slide. The first three is what we are positive on. We are all positive. We are positive on most of them, just at the first three we have coverage on. I think our viewers can download the reports on the GEMS website. So as I mentioned previously, most of the oil and gas players have their strengths and their kings. Just need to be aware of them and manage the risk if it realizes and how fast it realizes. But I just want to draw your attention is that, in highlighted green and red, that most Singapore investors love companies that are not indebted, meaning cash rich, such as Dynamac and Marco Polo Marine, right? Players like ASM Marine, Nam Chong are also OSV players, but they have also a lot of debt. So just need to be a little bit careful down there. But given the old saying, a rising tide lifts all boats, I'm pretty sure all of these companies are in a better position now than they were back before COVID. And just to mention Seatrium specifically, they have a lot of orders coming in. Outlook looks good, but most of the contracts only contribute next year. And even though markets are forward-looking, as we can see from the meteoric rise in share price, some of the players, Seatrium is bogged down by the Seed Brazil or Operation Car Wash, if you may, which led to the diminished confidence of investors and especially in steep players. So the wound and scat keeps getting picked on, even though it has sort of concluded with fines and jail terms. But if you look at the previous fines, it is nothing compared to the cash. Not saying it's not severe or slap on the wrist, just that, they have ample cash to withstand further fines. So all in all, most of the oil and gas companies have seen their prices move, and it's a flavor of the month, previous months, and I think there's still room to grow given the current macroeconomic conditions, notwithstanding a recession, of course. Yeah, thanks, Siva.
Okay, so you still see further upside, despite like Dynamax performance this year has been spectacular, right?
Yeah, for sure. I think the past few days, it's risen 10% every day.
I know, I've been watching it, my goodness.
Yeah, it's crazy. It's really crazy. The volumes show that in-state players are coming in. These are not normal retail players that are coming in, given by the sheer size of the volume. If you compare it now to historical volumes.
Yeah, I think the market cap has now risen over 500 million, right?
Yes.
Yeah, so that puts it on the radar of some institutions.
Yeah, you're absolutely right.
Okay. All right, so guys, that's some individual recommendations to think about in the ONG sector. Husseini, over to you. How about yourself? What would you be recommending?
Yeah, sure. So my recommendations are again linked to the theme, which is if the interest rate cycle turns, I think which are the names which are going to benefit. From that point of view, I would like to recommend three names. One is from the REITs space, which is First REIT, and two names from the telco space. So maybe drilling down further into the REITs, the First REIT, maybe a bit of background. First REIT is a healthcare focused REIT that owns hospitals and nursing homes in Indonesia, Japan, and Singapore. Around 74% of its revenues comes from Indonesia, which is from Siloam hospitals, and rest from Singapore and Japan. So as seen on the top right-hand chart, First REIT suffered revenue losses in 2022 owing to restructuring of its leases. Obviously, it was not a favorable outcome, leading to a massive share price correction. However, the good news is that company has restored revenues back to near pre-restructuring levels. Indonesian healthcare, from where they get 74% of the revenues, is also in a good shape, particularly Siloam Hospital, which are doing now very well, as seen on the right-hand bottom chart. And this in turn gives better revenue visibility and lowers counterparty risk for First REIT. Aging population in Japan should also benefit companies' nursing home business. Second catalyst for First REIT, I would say, or I see, is that companies backed by 9 to 10% dividend yield. Company just reported their first half results this Friday, which was in line with our expectations. Gearing levels are also reasonable at around 39.5%. Finally, company is targeting to expand into developed markets, which in turn will lower its exposure to Indonesia. So potential diversification would be positive and also will help to reduce currency exposure for First REIT. Let me move to the second company we like, is Netlink Trust. Shiva, if you can go to the next slide, please. Yeah. So maybe a bit of a background. Netlink Trust, they are the designated provider of Singapore fiber broadband infrastructure. Now, given that it allows for highly secure revenue streams as they are the regulated business. Company's revenues are regulated in nature, and the last regulatory review just concluded. Okay, so this means the revenue visibility for the next 5 years is very high. We estimate companies cash flow per share at around 0.55 cents, which translate to around to an attractive 6% dividend yield. Now, as the interest rate cycle turns, we see this defensive and yield plays, which is First Street and Netlink, to be the frontline beneficiaries. Now, before moving to my third pick or the next pick, which is large cap Singtel, let me give you a brief on Singapore's mobile space. Siva, if you can go to the next slide, please. So, from the Singapore mobile space, we are of the view that Singapore mobile sector is up for consolidation. Singapore, within the Asia, Singapore is the last market which has not consolidated. It has 4 mobile operators and 11 resellers, which makes it too crowded for a small market or a small population. And once it is consolidated, as we had seen in other markets, we expect ARPUs to stabilize and revenues to improve. With that, let me move to one of our preferred pick, which is Singtel. So, Siva, if you, yeah. So for Singtel, we see deep value as it is trading at around 33% holding company discount, as you can see on the chart. To put in perspective, Singtel market cap right now is around 37 billion USD. Okay. And they own 29% stake in Bharti Airtel, which is one of the largest telco in India. Market cap of Bharti is 108 billion USD. So for the 29% stake of Singtel, which is worth 31 billion USD, or equivalent to around 85% of Singtel's market cap. Okay. So just 85% of the Singtel's market cap is their stake in Bharti alone. And Singtel is much more than Bharti. They have material exposure in Australia, Indonesia, Thailand, and Philippines. And, Australia, they are the second largest operator, Optus. But all their associates in all other markets, Indonesia, Thailand, and Philippines, are the largest mobile operators or close to largest mobile operators. And Singtel is also the largest Singapore operator. They have data centers and many more. They have many more assets. So net, what we see is that at a 33% holding company discount, there is a huge value or deep value. Now, what qualifies Singtel to be part of a turnaround portfolio? Deep value is one, but what are the catalysts? First, we see is that Singapore mobile consolidation, which we just discussed. Second is the Optus turnaround. So Australia, the Optus business in Australia, no doubt was pain for Singtel. But now what we are seeing is that they are on a consistently improving path. Revenues in Australia are going up. Competition is highly stable. Prices are going up, the telco prices, and the OPEX and CAPEX for Optus is coming down. And last but not the least, we see company Singtel has given a very good visibility on the dividend side. And that is the visibility is for the next 4 years. And that translates to around 5 to 6% dividend yield. So what Singtel is offering is regular dividends at 70 to 90% of the earnings, and on top of that, they are offering 3 to 6 cents special dividends. So 5 to 6% dividend yield, which in my view is attractive. So with that, let me pause here and pass it back to Siva.
Okay, we have one question from the participants. I'll try to answer that because we are running short on time. The question is, with the huge amount of trades coming in from institutions, how high is the risk of these stocks becoming pump and dumps? For example, Bengquang, Dynamac, and Mermaid. Nick, would you like to take this question?
Sure. Okay, so with every sector, with the price going up, there will definitely be more participation coming in, be it from insti or retails. In fact, last week, if you look at the dynamic fund flow, you can see a lot of instis coming in. So I won't know whether they will become pump and dumps, but what I can rely on are valuations. And the most important thing when you want to assess a business is to see how much profit they can do, what are the expectations, is this continual, can this continue in the next few years, is this viable? And ultimately, at what valuations are you comfortable buying the price at? Even if it goes up to a high amount in terms of share price, if the valuation is cheap, there is no harm buying it. I mean, of course, in the short term there will be some fluctuations here and there. But if you believe in the valuation, believe that this price is cheap based on the fundamentals, then it's okay to buy, right? If it comes down, just average down. But of course, you cannot chase the stock to say that I see it rise so much, I want to buy a lot and follow. So these are the type of pump and dump that I think the audience is mentioning. So ultimately, you really have to see the valuations and at what levels of valuation you're comfortable with buying. Not just, oh, share price goes on, I'm going to buy. It's like a tulip frenzy or the crypto mania, right? So it all boils down to valuations, honestly. Thanks.
Okay. I think we have run out of time. It's now 2:11, so I think I better wrap it up. Thank you again, guys, for taking the time. I'd like to thank Nicholas and Hussaini for giving their expertise and their expert views. As I mentioned, these guys are the ones who are in the front line, putting their names and reputations on the line every day with the reports they produce. So I'm very grateful that we've had the benefit of their participation for today's session. Otherwise, I hope that everyone here who has been watching has taken away some valuable insights into how to play the turnaround for the remainder of this year when interest rates are most likely to be cut. Okay, thank you very much for attending. And is there anything that I think we can leave the session? Is that right?
Thanks, everyone.
Thank you.
Okay, thank you, guys.
Thank you.
All right, thank you so much.
Thank you very much, Nicholas, Hussaini, and Siva, for the very, very insightful final discussion. Ladies and gentlemen, we have come to the final segment where everyone is excited for our lucky draw. Before we proceed to draw the winners, we would like to thank everyone for staying with us throughout the entire event and hope you had a great time learning and listening from the industry experts. We would also like to thank Singapore Exchange, Securities Association of Singapore, and all valued partners for their valuable support on making SG Gems a success. Without further ado, we will now proceed to draw 3 lucky winners who will each win a $50 Takashimaya voucher sponsored by UOB Kay Hian. And congratulations to Jensen Wee for being the very first winner for this segment. Next, we'll draw the second winner. Congratulations, Emma Chia, for being the second winner. And right now, we'll pick the third winner for the Takashimaya voucher. Congratulations to Terence Ngoy. Yeah. Next, we'll now proceed to draw 3 lucky winners who will each win a $50 Fair Price voucher sponsored by FSM1. And congratulations to the first winner, Conrad Chong. Next, we'll draw the second winner. Congratulations to Loy Fong Chin. And we'll draw the third winner for the Fair Price voucher. Congratulations to Mr. Richard Ho. Next, we'll now proceed to draw 3 lucky winners who will each win a $50 cash prize sponsored by Lim & Tan Securities. Congratulations to Mr. Patrick Lim. Next, we'll draw the second winner. Congratulations to Wei Hao Tai for being the second winner. And next, we'll draw the third winner for the cash prize. Congratulations to Gurjit Singh for being the third winner. Now, to conclude the lucky draw, we'll now proceed to draw one lucky winner who will take home a Nespresso Mini, proudly sponsored by Maybank Securities. And the lucky winner goes to... Congratulations to Lim Yi Kun for being the lucky winner for this Nespresso Mini. Now, congratulations to all the winners, and I will reach out to you soon via the email or mobile number which you use to register for this event. Ladies and gentlemen, we have come to the end of SG Gems 2024. Once again, thank you all for your time, and we wish you a pleasant day ahead.